today, topic's going to be based on actually a conversation I had last night with someone. Someone reached out. They had a significant amount of capital they want to invest, nearly $500,000, and they want to buy townhomes in and outside of the GTA. And the reason for that is they had done very well in the KW townhome they bought last year. And my answer to them was, why would you want to buy a townhome in or outside of the GTA? That's the exact market that's right now. So you're going to be buying at peak period wise. I don't think that is the right investment to make right now when you have different options out there on the table. I don't. Any real estate there can be arguments to make about good investments, bad investments, and everything like that. I think you'll be fine in the long run, but I don't think it's the right investment right now because you can be buying right at the peak period wise. And I was thinking about this conversation this morning, and I thought of a great analogy to make with it to visually show people where the opportunity is, which we believe is condos in the downtown Toronto market-wise, which have gone down. The pricing of condos have gone down, and we see great opportunity there. So the real estate market lags the stock market by about 6 months. So now is when we're starting to see the cracks in, I shouldn't say cracks, but we're seeing pressure on the condo market-wise. So what I'm going to do is I'm going to share my screen, and I want to show everyone something. So if I look at, let's look at when the pandemic hit. So pandemic hits beginning of March, CIBC stock goes down. It hits a low in March. Where's that low? March 23rd hits a low of $67.61. That was the low for the stock wise. So that was pandemic, lots of uncertainty in the market wise, what's going on. People divested, sold. But when you think of the fundamentals of the stock wise, you're like, wow, this is a bank stock. Canadian banks are some of the most conservative and secured and well capitalized in the world wise. I'm not too worried about it. Maybe I should buy. And I thought CIBC was an incredible buy, that opportunity. If you take a longer term focus on it, going, it's not going to stay this way. And fundamentally, bank stocks are good, safe investment wise. So I'm going to buy when it's down. This is a good stock to buy. Well, what happened? Well, so that's March. So then we start seeing ups and downs, but pricing slowly going up on the stock. And so at the peak, well, if we look this year, right before the pandemic, pricing was around, it was under $110. And guess what? We're at $110 now. We're actually higher on this stock than it was pre-pandemic wise.
So if you look at the summary, the low is 109 and the high is 110.
Yeah, perfect. Thank you. Yeah, there, I had it for me. I didn't have to do it. Okay, so the summary is right there. So we look at the summary right there. So we see the low and we see the high on the pricing wise. Now, here's another thing to think about. So we saw the market tank, and then we saw it recover on the fundamentals, knowing, hey, the bank's actually going to be okay. Once you get through all the uncertainty and everything that's going on, and you think about it, you're like, the bank stock's going to be okay. There's a vaccine coming around the corner. It has good capitalization. Things are going to be okay. The other thing, especially in these time periods wise, there's something called the dividend yield. So what the dividend yield is, what makes a bank stock attractive is that they will pay you a dividend based on the number of shares that you own. And what that is, they'll literally put cash in your bank account depending on how they pay it out. So let's say they pay the dividend quarterly wise. Every 3 months, the bank is going to put cash into your bank account wise based on the number of shares you own. So whatever happens, you're going to get a check in your bank account. You're sharing basically in the profits wise of the company. So by owning some shares in this company, you are going to get money. So because the stock price was so low then, the dividend yield was quite high. I remember the dividend yield. Did it go over 8%, Kyle, at one point? I know it was definitely.
For some of the major banks, it definitely did. Some of them were 10 to 12%, I think, at one point.
Crazy, crazy. So that means by buying a stock at that specific low point of price-wise, the return on the owning that stock at that price-wise was 10 to 12% for owning that stock. It was absolutely crazy. So thinking about that this morning and applying the dividend yield concept to the real estate market, specifically condos downtown. So where are we in condos downtown? Well, right now, we are March 23rd. We're in and around March 23rd. We're blanking around here. That's where we are right now. There isn't good news in the condo market wise. All the media has picked up going, oh, rents are falling, inventory is falling, people are moving out, all those different things. So the negative media cycle has hit in. So we're right here in the condo market wise. That's where we are. And here's what you get when you buy a condo or any piece of real estate for that matter. What you get is you're going to rent the property out. And what renting out, that's your dividend. That's like your dividend. That's a cash going into your bank account wise. So you are able to attach a revenue stream to the property, just like a dividend to a bank stock wise. Now, not every stock pays a dividend wise. More mature stocks pay dividends. So your condo is like a solid blue chip stock that you know you're going to get rent for. So we're going to get rent for the property wise, but the pricing is all the way down here on the valuation. Now, when people were looking at the bank stock, they're like, well, when it started going up, they're like, well, actually the fundamentals of the banks didn't change. Things aren't that bad out there. You know, it's actually okay to own this, and I'm going to be getting a return on that. I know I'm going to be getting money every month. That makes me feel confident wise. So that's why I invested money in bank stocks around this time. And I put my child's saving, RESPs in bank stocks. I'm like, this is safe, secure. I don't need to worry about it. I'm going to put it in here. I know the values are going to go up. The banks aren't going anywhere. I know the dividend yields are going to stay around. So yeah, I'm going to buy bank stock. Same thing with the condos. Condos. You're going to buy the condo. The fundamentals of downtown Toronto have not changed. There is no change in the fundamentals of condos wise. So when we look at downtown Toronto, and this, if you look at all our other videos, we talk about, well, why are there vacancies in condos in downtown Toronto? Why is there some sensitivity in the pricing on condos in downtown Toronto? Well, office buildings are closed. So office buildings are not open. The vibrancy of living downtown, restaurants, live sporting events, concerts, conventions, all shut down. So that lifestyle isn't there. Other feeders into the market, international students or immigration, well, those took an impact this year because travel was mitigated due to COVID concerns this year. Okay, those all stopped. Well, these are all temporary effects which are going to go away. These are all man-made restrictions-wise based on trying to control the spread of COVID-19. Well, the vaccine is now around the corner. The UK just approved their vaccinations wise. Those are going to be beginning very, very shortly wise. The US is right behind them. Canada will come in. So we're going to have a vaccinated country. That'll happen most likely by September 2021. So the fundamentals, there has been no, and I wrote this down, there's been no fundamental infrastructure change in downtown Toronto, which is going to have the fundamentals of pricing on condos change forever. Now, before I go further, guys, do you see any fundamental infrastructure change that will prevent people from going to work when office buildings open up, or when restaurants of vibrancy, when sport teams coming out back up? Talking with sports teams, they want to tear down the Rogers Center. Well, you know how expensive that is? These are billions of dollars of infrastructure projects wise. The infrastructure here, the infrastructure is built, it's permanent wise, it's not going anywhere.
So there are changes that are actually going to benefit living downtown, where there are actually infrastructure projects. You know, people had asked, people not going on the TTC right now? Should we still continue to move ahead with these projects? And the city and province said, absolutely yes, we have to keep continuing with these sorts of infrastructure projects. Plus, in order to recover from the economy, there's going to be massive stimulation in the form of other infrastructure and spending as well, which is only going to benefit, downtown and the surrounding areas, and another reason to live downtown. So I only see pluses really for the downtown market, not negatives.
Yeah. And then Ammon, I know you wanted to talk about money.
Yeah, so I mean, a lot of points to touch on, just to hammer the Rogers concept. They're in debate of tearing it down and building a new one right on the same spot.
Yeah, same spot.
It's not on the same spot. They're talking about maybe on the east side where the waterfront is. So if you look at a multi-billion-dollar corporation like Rogers, I think they bought the Skydome for what, 25 million or something, some ridiculous number because they were going under. And they're sitting on multi-billion-dollar property. And if their investment teams, who are probably much smarter than us, are deciding that it's worth it to spend, $3 billion building a new complex right in the heart of the city, they obviously have done their cash flow analysis and looked at the viability of Toronto, and they see it going higher, which when you look at the direction of builders in the city, nothing's going to change. I mean, yes, people are not working, you have bank employees not there, and you have some buildings where commercial space is down, but with a world population going from 7 billion to 10 billion, you have 3 billion people that still have to be born and allocated to different cities across the world. And you're going to see an increase in density everywhere, whether it's this year or in the next 15 years. In regards to the cash flow, people are sitting on, we talked about this over the last couple of meetings as well, but the chief economists at all the banks, one of the main things that they did not forecast was that the average savings a person had was 5% of their income, which is about 16 days. And now with COVID, people aren't spending at restaurants, people aren't buying fancy clothes, kids' tuitions don't have to be paid, people aren't paying for Kumon, people are saved a lot of money. The mortgage deferral has put 6 months of mortgages cash flow back into people's pockets, and that savings rate has jumped up to 28% of annual income, which is it's close to almost 100+ days of savings. So, the market was expecting this era of evictions, as they called it, that was going to, pump into the economy in Q1 of 2021. I think that's been delayed potentially indefinitely, because as a vaccine kicks on and people return to work and people's savings are there to boost them through the final stretch, I think, crisis is not by any means averted. Everyone still has to be safe, but you're going to see a L-shaped recovery, as they call it. It's going to take some time. It's going to tickle up every day. There's stories in the Toronto Star and in the newspapers of bars and restaurants that have sold their beer and their inventory and stock, and they've found a way to make it through for the next 4 to 6 months. So from a cash flow perspective, people are holding on. Not everyone, but people who are in the house buying market have more money than they've ever had before. You got interest rates at lows that have never been seen, all the way back to human history. Even during the Great Depression, rates weren't as low as they are now. And Mark Carney, who was the ex-Bank of Canada governor, who was taken over to Bank of England, made some changes there. He's come back, and he's predicting negative interest rates from a government loan perspective. So no one knows the impact of all these things. And just to sum it up, and I'll give it back to you. Out of the G7 countries, because it's not G8 anymore because Russia was kicked out. But out of the G7 countries, 3 of those countries are already in negative rates: Germany, Denmark, and Japan. Now, people think, oh, negative rates, that means my mortgage is going to be minus. No, the Bank of Canada lends to banks at minus rates, and the banks will, jump it up 1-2%. And so that's why you're seeing these 1.5s and 1.6 rates. And I think it's going to go down from here. We operate as a global economy. So if the rates in Denmark are 1%, why would people invest in Toronto? So you're going to see Toronto catch up. So that's kind of where we're headed.
And I'll add and bring it to what bring it back to what I started in regards to townhomes in and outside of the GTA. I'm from a small town in Northern Ontario. but people, and then we'll talk about a little bit about the cottage market too and everything like that. So you talk about the cottage market went up anywhere between 15 to 40%. You see upticks in all these smaller communities, people buying properties and everything like that. Here's what I know about condo owners and majority of people that own Toronto houses. And guys, you might have to beat this out on the editing wise, but people don't know about how to maintain a house, let alone a cottage property with septic tanks and all that kind of stuff. Do you know the issues that people are going to have to deal with wise? Bandwidth, it's going to have on YouTube, it's going to have to go up massively just for everyone, just figure out how am I going to run all these projects wise. And we're in a period where trades are at a premium. There's a lack of trades out there. There has not been a transfer of knowledge wise from our parents' generation to us in regards to the skill sets that they had to maintain their own properties wise. So people don't know how to maintain their own properties. So that is going to be a major shock to people, people dealing with all these things and the issues with these properties and everything like that, especially the cottage properties wise.
One word for cottages: winterization.
Oh my God, like just
don't even want to deal with it.
Crazy amount of stuff. So I'm not saying these were bad investments, but you had a quick run up in the valuations of these properties. So to expect that run up to continue is not realistic wise. When you look at the whole historical pricing on these things, people fled the city because the city shut down. When the city opens back up, people will come back. Now, I want to show everyone something. So I put together this spreadsheet yesterday wise, and it went out to people that had signed up for the condo deals. And I'm going to go back to sharing my screen again. So share screen. Okay. So share, here we go. So you guys see this again, right? The list of properties here. I'm not going to go through every single one. I did a video on that yesterday. It was 18 minutes long, but I cherry picked one just to talk about today. And I can talk about it very well because I own this exact same unit in this building. So I know it intimately wise. My money's tied up here. So I can speak to it. So there's a unit for sale in this building right now, unit 1503. It's a studio. It's listed for $449,900. And I want to add to everyone, I'm not a salesperson here. Hal's not a salesperson, Amit's not a salesperson. We're a salesperson if we're selling your specific property wise, but in the hat that we're wearing right now, we're just advisors. We're showing you opportunities wise. Whether you act on this or not, I don't care. But I just see opportunity and I want to share this with everyone. And I want to instill our knowledge to you because we see this great opportunity. So if I look at, so we see the units listed for $449,900. I put a buy price on it for $420,000. Want to know why? Because just last month, one sold for $420,000. Now, where's the opportunity? Well, earlier this year, the same model sold for between $525,000 and $557,000. That happened in January and March of this year. So we're looking at roughly 10 to 11 months later, we're down to $420,000. That is over $100,000 less than this exact layout had sold for earlier this year. That's incredible. That's absolutely incredible. So what do I see? I see opportunity because we go back to the fundamentals of Toronto. Have those changed? No. This is a Yonge Street property. It's 7 Grenville, but it fronts on the Yonge Street. It's just how the addresses work. This is at Yonge and College. This is prime downtown real estate wise. If we looked at this unit pre-construction wise, it would be well over $600,000 in regards to the sales price of this. So we're looking at pricing $420,000. We saw earlier this year, these units were selling for over $100,000 more. So let's go back to this property wise, 7 Grenville, 1508 studio wise. My recommended buy price $420,000. Emma was talking about earlier. We're talking about interest rates, record low interest rates, potentially still going to go down from here. So yes, rents have gone down and that impacts your cash flow. But prior to COVID wise, interest rates were around 3% on a fixed level. So I can tell you on this unit, I have a 3% interest rate. That's what I have on this unit. So my cash flow is different than the cash flow you're going to look at because you're not going to pay 3%. I have this calculated at 1.8%. Maybe you'll get lower. Maybe it'll be a little bit higher. We're trying to take a middle ground. So 1.8% on this. So your mortgage in this is $1,200. Your maintenance fee, $257. Property tax, $129. What does that mean? Your running cost is just under $1,600 per month. Now, I just rented my unit for $1,450. So that means I am negative in the cash flow column by $145 per month. But I have monthly principal payback. Now, because interest rates are so low, that monthly mortgage payment I make, that $1,208, 710 of that dollars goes back to paying down the principal on the property. When interest rates are so low, your principal payback is very, very large. When interest rates are high, your principal payback is low relative to the interest payment wise. So even though my cash flow is negative 145, I'm still significantly in the black every month, over $500, $564 per month, because every month $564 of debt comes off. So I'm paying down the mortgage on the property. Now this is where things get exciting. So let's go to 2022. We know that these properties sold for over $500,000 this year, this calendar year. That happened between 525 up to 557 for those units wise. So I put an expected value in 2022 of 525 because things will start to go back to normal in 2021 with full recovery in 2022. This already happened. This is historic price point wise. This, if we go back to our CIBC charts, we're buying at the bottom, and then we saw that pricing spike back up in this calendar year to above where it was in January before COVID wise. Isn't that incredible? So we know it's going to happen. 525, the rent. Well, we saw these renting all the way up to 1950. I was getting on rent wise. So we go from a negative cash flow situation to a very positive one, over $300 per month. My monthly principal payback still stays the same at $710, but now on a monthly basis, over $1,000 per month in my pocket in the black wise. Isn't that great? And my appreciation, whoops, I got too excited. My appreciation on that in one short period wise, it could be 12 months, it could be 18 months, but $105,000. That's incredible. Now it gets even more exciting because we don't look at everything in 1 year periods. We look at them 5, 10, 15, 20, 30. I only did 5 years. So then we go to 5 years, 2026. We apply a 5% compounded annual growth rate on the property starting in 2021. So we're looking at this property in 2026 being worth $638,000. Plus we have cash flow and principal payback of over $55,000. In 5 years, your gain is $273,000. You bought at the bottom. Congratulations. That's why you don't buy a townhome outside of the GTA right now, because that's hot. This is the opportunity where it is right now. Buy when it's down and profit on the recovery. Isn't that a great? I told Kyle I was so excited about this today. Isn't that awesome? Isn't that incredible, guys? Like when we put this spreadsheet together yesterday, it was exciting. I do it for 3 weeks, but it took time for me to clear my head and get an idea of what was going to go on there. But how powerful is that? Like $100,000 like this, easy peasy, for a negative cash flow of $145 per month. Maybe it'll end up being negative 200 because maybe you won't get $1,450 right now.
I think that's where some short-sightedness sometimes kicks in.
Oh,
you look at your monthly cash flow, which is a coffee a day, and you're forgetting about the upside potential on the value, as well as the downside mortgage reduction, which is someone's paying your mortgage. So you're making money on the up and the down, and the cash flow is nothing. So
like when I had this conversation with someone last night, just concerned about condos and wanting to go in the townhomes. Now I don't blame them. They had bought something, they had done well on it, but you gotta look where the puck is headed. You know, the old Wayne Gretzky analogy wise. You know, where is that going? You know, this is Kyle came up with the line once generational lot. Like, when is this going to happen again? I don't even think it was this good. It wasn't this good in 2008 in regards to financial crisis. Why? Because that was more structural. The financial crisis was more a structural issue. This isn't a structural issue. So that's what people have to remember. As Amit brought, $150 billion are on the sidelines right now in regards to the savings, in regards to how the government structured the recovery so that the economy won't go like this. It was all about treading water, and then it's going to go like this. We've seen it in the stock market already. It's already happened. TD, $5 billion profit in Q3. That didn't happen in 2009 or 2008 when the financial crisis hit. So that's where people have to follow things. That's where things are going. The opportunity is downtown Toronto condos. I think that's the easy opportunity. When I say easy opportunity, the other thing I have to add about owning multiplexes and townhomes and freehold properties, again, I own them. I own multiplexes. I own freehold properties. I don't have an issue in regards to owning those in your investment portfolio. There's good diversification and doing different things. I just don't think now is the time to be buying those. And the other thing that comes with those is they're more work. Condos are concrete boxes in the sky, specifically downtown Toronto. So what goes wrong in a condo? Well, it's only what happens in the 4 concrete walls. When I own a freehold property or a multiplex, I'm not only responsible for what's in the concrete walls, I'm responsible for the building. So I'm managing 2 different aspects of a property when I get to a freehold property. In a condo, I have someone already managing that. I don't need to worry about that. The only email I may get is, I clogged my toilet. What can I do? Like, that's the message you get, and you tell them to go buy a plunger. It's not even your responsibility. It's the tenant's responsibility. Your worst case scenario is there's an appliance issue. These are the things you deal with. Also, you're getting AAA caliber tenants. So when we've run our Bill 184 seminars, the tenant issues weren't on condos. All the tenant issues were in freehold properties. And typically they were outside of Toronto. They were more GTA or outside of GTA properties, and very, very bad issues. Those were they weren't condos that had the bad tenants. It was all these other properties wise, just hearing about non-payment of rent, trashing of the property, infestations of pests and cockroaches and everything like that. Terrible. Like, people, if they heard that was your experience being a landlord, would run away. But they were all in the freehold properties, not on the condos. Because again, you have someone managing the building. So if there's actually a tenant that's causing a problem, that'll get nipped in the bud pretty quick, because your neighbor is going to complain and the building's going to get on that. So you're not going to have a long lingering issue. Not that we have those, but there are safeguards before it gets to you. And then number 2 is that it's only the concrete box, and we're getting AAA caliber individuals in these properties. So don't go run to where you see it being hot right now. I'll throw it out there. Does anyone want to buy Tesla stock right now? Like, why would you buy Tesla stock right now? Like that's
no way.
It's hot. Yeah, you can buy it right now, and it still may go up. But the downside risk is massive. The downside risk.
Tesla stock is almost worth every automotive company on planet Earth combined. Like, I also love the brand. It's great. Like, I hope the world electrifies, but the amount of hype, and they call it a flyer stock because it's way up in the clouds. It's too much. And I think Tesla's up 450% since COVID, along with all the big techs, Amazon, eBay, Google, etc. Like, again, when we look at that, assuming that pans out, those are the businesses that are going to take over downtown Toronto. So those employees are going to come back. So it's full circle.
And I'm not a stock expert. So again, don't take I don't care what stocks you buy, but I'll tell you what stocks I did buy. So I told you about the bank stock that did well in that. Also, I bought REITs. I bought REITs in the summer. So I looked at, well, what is still being hurt here right now? I'm like, oh man, the REITs like, so by the summer, you've already saw the recovery of the banks wise. The REITs, the real estate investment trusts, those were still down. I'm like, man. And those, the dividend yields on those, again, 10% for RioCan. It was, I bought it at 8% for H&R REIT-wise. And I'm like, well, the underlying value of the assets that these companies own, especially specifically in RioCan in this case, outweighed the total valuation of their stock and everything like that. I'm like, well, this just makes sense. And they're gonna pay me on a monthly. They pay their dividends monthly. They're gonna pay me monthly for owning their stock, and they're gonna pay me 10% of my purchase price. That seems pretty good, because I'm in it for the long run. There may be ups and downs, but guess what? You know, these stocks are up between 20 to 50%. This is great, and I'm just buying in the long run. I'm for the ride, because I know fundamentally people will return to the assets that these people own and manage. So it's all about, but did I buy a Tesla stock? No. Did Tesla stock go up? Yes. But I know that the downside risk is there. The downside risk of owning these properties outside of the GTA is there. The downside risk of having a bad tenant and then having to deal with that bad tenant in a town that's not your own town. So imagine living in, let's say you live in North York and you buy a property in Oshawa, okay? And you get a bad tenant. How are you gonna deal with that? You know how long it takes to get from North York to Oshawa? Just think of the 407 bills you're gonna be running up every month trying to deal with that. Trying to deal with that after you work your 9 to 6 job, realistically wise, and then, you know, putting your kids to bed. Now you're dealing with about 8 o'clock. Now you're gonna go out to that property. Who's gonna handle that? So that's what you have to think of. You know, downtown Toronto is very, very easy to deal with. I feel like I'm getting into rambling territory now, so I'm going to stop. Kyle, Emmett, anything you want to add on this before we open it up to some questions if people have any?
I just see this as really a once in a lifetime opportunity. Buy a depressed AAA asset like a bank stock, you know, buying condos downtown. It's a price point that we won't see again. And getting cash flow for properties downtown was a challenge at the beginning of this year. Now you have an opportunity to get a property that can be significantly positive cash flowing a year from now, plus significant appreciation potential. For me, those are the two major evaluation criteria we use for any of our investments, and it's here right now for the taking.
Yeah, just to add to that, I mean, this is long-term, right? Slow and steady like a train. So you got to look at it as a 5, 10, 20-year horizon, just like that stock chart. We got to remove the short-sightedness and the monthly cash flow and look at what the upside potential is, because...
And actually, great point, talking about upside potential. Okay, so when you buy these properties, you're typically buying them with a mortgage-wise. So you're getting a mortgage on these properties. So that means your business partner in these properties is the bank. So if the bank, which Canadian banks are historically conservative wise, if the bank is providing you a mortgage, they believe in the fundamentals of the market. So let me ask if the bank is still giving mortgages on condos.
Yeah, left and right.
Yeah, the bank's still giving mortgages on condos. So I'm gonna give one other example. As when we talked about a once in a lifetime opportunity, I have seen this once in a lifetime opportunity before, but in a different market. So let's go back to 08. 08. Now I didn't have any money in 08, so I couldn't do this. But 08, you saw the crash of the American market. So 08, 09, 10, 11. American real estate market, bottom fell out. We all know that. But also, currency-wise, we were above par. So the Canadian dollar was worth more than the American dollar at this time. So you saw the, get my pen here so you saw the American market go down, but the Canadian dollar is not working. The Canadian dollar was up. It was a huge opportunity. It was like, oh my God. The Canadian dollar historically trades at 80 cents to the American dollar. And the American real estate market has just crashed. Well, we know that that's not, the American real estate prices will go up. Historically, real estate prices always go up. So you buy the dip on the real estate price, but the currency the currency was an additional 20% bump played in right there. And you knew that the Canadian dollar was not going to stay more valuable than the American dollar. The American dollar is basically the gold standard for the rest of the world. So that wasn't going to stay like that. So if you had cash at that time, you could take advantage of that opportunity. And anyone that bought in the States in 09, 10, 11, oh, they did extremely well. Again, you needed money for there. And I'll also add this, getting a mortgage down there at that time, that was difficult because the banks down there were not giving mortgages at that time. But where we loop that back in, the banks are still giving mortgages on condos. So, and we're way more conservative. So if you just look at it, our conservative banks with, again, TD, $5 billion worth of profits, writing checks still, investing in the Toronto condo market, not worried at all because they focused on the fundamentals in the long run as well. They know that Canadians have $150 billion saved up in their accounts. They are not worried. And you know what? The banks have a telephone and pick up telephone. They can talk directly to the PMO office. And the PMO office will pick up their phone and talk directly to the heads of the banks. Everyone is working together. So you have no worries about the bottom falling out. Take advantage of the opportunity as it presents itself. Well, I'll just add a few more comments wise. If you're interested in taking advantage of any of this, recap will be sent out to you. You can book a call with Kyle or myself. If you need the capital to unlock capital to invest, you saw that spreadsheet, you're excited, call Amit. He'll be able to hook you up with that, the capital wise, and also to get the mortgage on that property. Amit's best line, Amit, who can get a mortgage?
Everybody.
Okay, so guys, a recap will go out. You'll have all our contact details. Thank you so much for coming on. That was fun today, and we'll talk to everyone soon. Okay.
See you guys. Bye.
Everyone.